reflection on the market open in Asia and the direction of travel for the rest of the day. Markets have opened this Monday morning in Asia with a bit of a fall after recovering last week. Let's kick off this morning with our regular Monday morning commentator, Omar Najia, Global Head of Derivatives at BB Energy. Omar, welcome back. I hope you had a nice Eid break. Omar, since we had the chance to talk last, obviously we've had the OPEC Plus agreement, and we have also seen a bit of a seesaw. Prices sort of collapsed last Monday and recovered all last week. So we have another Monday morning where prices seem to be taking a strong decline. Your thoughts on where the market direction is at the moment?
I think basically the market got not overexcited, but I think like I was saying, when the bears become bulls and everybody starts talking these, $100 and whatever it is, we saw the fall. And in the same way, so we fell from $76.98 to $65. And now I'm sure it's going to be like, demand is dead. And I'm sure there's going to be talk about variance, and everybody's like, it's, now it's finished, whatever it is. So on that thing, I think we're going straight back up again. So my next target is $81.50 basis WTI. And once we get there, I won't be so friendly to it, but I think higher. I think, in general, I think the market is quote unquote risk on again. There are some worrying signs in stories. I tend not to read that many kind of stories, but today I was reading Bloomberg and I saw this headline. I didn't click on it, but I saw this headline saying, like, could equities go up forever? Which is a little bit worrying when you read that kind of stuff. But hopefully there can still be some bearish people around to kind of sell and give us a little bit more impetus to the upside. But I think it's the summer, people are usually happy, sun is shining, that kind of stuff. So I like the markets higher. Oil I like higher because, as I say, I think 65, it was supposed to be the death of oil, and here we go, and all the rest of it, and it did a pretty nice V-shaped kind of recovery. So 81.50 for me for WTI.
Well, let's head across to Bloomberg and Mike McGlone, a bear of sorts, senior commodity strategist at Bloomberg Intelligence. Markets going up forever. It kind of feels like that. I suppose the same question is, will the Fed print money forever? Mike, your thoughts on the market direction? My sense is still looking for one after the OPEC Plus agreement.
Well, I guess Omar and I make a good market. I'm bearish. I do think crude oil is much likely to head closer to 60, using WTI as my gauge. I think sustaining above 75. I think there's a cap in commodity. Crude oil is the primary one that's capped. Natural gas around $4. This has been a level that's held resistant years, and every time we get up here, U.S. supply just cranks it out. And we have had a cap in copper, and lumber, and corn, and soybeans. So I'm quite bearish commodities at these levels. I think the market forgot about supply elasticity. U.S. supply is coming back. People forgot about free market capitalism. And demand, sure, we've had a spike in the short term, but the bigger picture is we're going to go back to what we did before. Demand's been lackluster in the United States for 20 years. It's basically the same. And supply is kicking back. So I'm very bearish commodities levels. And as Omar mentioned, the stock market has to go higher for crude oil just to sustain above $70 a barrel. If we get, just say, a minor 10% correction, which used to be normal in the S&P 500, I think WTI is going to get in a 50 handle easily. And that's just the average price of the last 5 years is $51 a barrel. The average cost of production in U.S. shale is now $35 a barrel. So to me, the facts are very poor for crude oil and very much favorable for crude oil just to be do the same thing it's been doing since 2014, trade in a lower range, get up to the upper end of the range and fail.
Well, let's bring in the man in the middle, so to speak, Marc Ostwald, Chief Economist and Global Strategist, ADM Investor Services International. And by being the man in the middle, Marc, I mean you're sitting in Poland, which is nearly halfway equidistance between New York, where Mike is, and Omar in Dubai. Marc, the question I think a lot of this might revolve around is, where is China going? And we certainly had reports, recent analysis reports that would indicate China is in a bit of difficulty. Your thoughts?
I think it's been escalating all year. It started off with trying to control commodity prices, and now China seems to be really living up to this moniker of command and control economy. They're intervening everywhere. The education shares today have collapsed because of the interventions there. They're talking about more interventions in the oil market to try and avoid the dependencies there. And we still sort of got a bit of a hangover. We certainly know if we compare sort of things like the gasoline exports relative to crude oil imports, they're basically not really getting the sort of traction domestically in terms of the economy recovering that people had hoped for. So they end up obviously exporting more product. I think the key point here is I'm not really quite sure what the Chinese authorities are trying to achieve here. Greater control is actually not great news for the economy, and they do need the economy to start improving. The biggest problem at the moment is consumer demand in China. It's just not picking up at the sort of pace that it was. You're looking at, as a rough comparison, retail sales and consumer spending is running at about 5% year on year. Pre-pandemic, it was running about 8 or 9. And then you've got all these other interventions in tech, in education, and you can't help but feel that what they're doing is actually not very conducive to a rapidly expanding economy. It'll be interesting to see what the IMF say tomorrow in terms of the revisions to their economic forecast for China, particularly in the context of a weaker Asia.
Mark, in terms of China, just quickly, do you think we have a sufficient view into it, or are we still sort of blocked out and being dependent on Chinese government numbers, and so the full picture may not be as immediately available as it might be in a Western market?
Yes, I think it's a situation where what they're doing is actually making things that much more opaque. So we are going to be even more dependent on high frequency type data to try and get a gauge of what is actually going on the ground. But the bigger concern for me is this overhang of debt that they've got, and the fact that they're trying to manage it, but it's not an easy task. It's not an easy task for them, let alone anybody else anywhere in the world.
Omar, looking structurally at the last week vis-a-vis the market movement, obviously we saw Brent drop below 70 a week ago, Monday, and if we'd had you on then, it would have been really interesting, your thoughts. But given the cycle since then, structurally dropping below 70, was that, obviously it brought a lot of people back into the market. Now we're looking at a soft opening today. Where do you think structurally that correction last week has fed the market for momentum going forward?
Well, I think basically, look, there's kind of it all depends on timeframes, right? So if you look at commodities in general, you can see that most of them are in bear markets. That doesn't mean they don't rally. Same with oil. I'm not telling you that basically oil is going to go and set new highs above 150 and all the rest of it. So it depends on your kind of time frame, but I do think oil is going higher in the short term, and then 2022, maybe second, whatever, Q2 onwards, we go and we correct, down. Maybe we get to 50 back, then, and then we go up again, blah blah blah. So I'm much more interested in that kind of stuff rather than, bullish and bear. It depends. It really does depend on the kind of time frame. I think a lot of people got. The market got a little bit ahead of itself, and then when we got to 65, it was the death. And again, market, sentiments become so negative that it flips and it goes the other way. And I think, the other thing is that's very interesting for commodities and for equities, for the S&P at least, is the dollar index. Now, the dollar index has been, we set a high in January 6th, and we went down to about 89.20. And we've rallied since then, and we're coming back up to about 94, where we're 93%. Maybe we get to 94, 94 and a half, something like that. But if that thing actually dumps when it gets there, then it could go down a long way. And if it goes down a long way, then all this stuff about, bullish, bearish, blah, 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 goes out the window. Because if the dollar index is going to go down massively, and there is a possibility, there's always a possibility, then what happens to the price of commodities? What happens to oil? What happens to gold? What happens to, Bitcoin, wheat, all this kind of stuff? So it really does depend on the kind of time frame. In the short term, am I bullish oil? Yes. Am I bullish commodities? Depends which ones. I'm positive the market, and same with equities. If the US dollar tanks, then is Apple worth $1 billion or $2 billion if the dollar goes
or 5 trillion?
Yeah.
If you forget about your B's, we're into T territory. Mike, speaking of direction for the dollar, one of the big sort of notes this week will be the Fed will release its policy statement on Wednesday with, sort of growing questions about whether they're going to scale back on easy money or not. How big an indicator do you think that will be for the markets? What do you expect them to say?
They can only say the same old stuff they've been saying for the last 3 months. The Fed's not doing anything other than they're buying a lot of bonds, and it's a competition between the US and the EU and every other central bank on the planet. And I love this narrative about the dollar, because to me, I always like it harkens back to what Churchill said about democracy. Anybody who's bearish dollar think it's going to collapse, I said, give me one good currency that's going to outperform it. And to me, it's just, the dollar is it's the worst of all forms of currency except for all the others. So that's why I'm bullish gold, I'm bullish Bitcoin, but the dollar versus every other fiat currency on the planet, which one's better? I mean, it's the dollar. And which one has a higher yields? It's the dollar. Which one has a better performing stock market? It's the dollar. And when those tanks come down from Russia, who's going to save you? It ain't going to be England. So I just love that narrative. And then you look at the dollar index for the last 40 years, it's been going up. The last 10 years, it's been going up. And I use the trade weighted, and it's got a lot of fundamental reasons to continue to go up. That's why I'm bearish commodities. But the dollar is going down together with all currencies. That's why gold and Bitcoin should continue to outperform. So to me, that's a big picture thing to think about. And now we've had a correction. The dollar's had a correction in this trend. That's, I think, it's more likely to go higher. Crude oil's had a correction in the bear market near the upper end of the range. It's more likely to go higher. And the two key commodities I'm really bullish on is gold and Bitcoin. They're fundamentally solid. They're quasi currencies, and they've had corrections in the trend.
Mark, your thoughts on the same point? We have data due Thursday that will likely show U.S. economic growth accelerated in the second quarter, but maybe below expectations. Your thoughts on the outlook?
Yeah, I mean, we've got all this GDP data this week. I can't help but think, with all the concerns about infection rates rising, particularly in Asia, in parts of the United States, in parts of Europe, that we want, the markets may actually already trash the GDP numbers as being historical, because people really do want to know what's going to happen in the second half of the year. And it is actually a very uncertain outlook. I think what's interesting in terms
has it become more uncertain, Mark, in that sense? I thought we felt like in early summer we had a more sort of certain outlook, if you like.
Yes, I think people felt confident that, particularly with Europe, continental Europe picking up, and it has picked up very markedly. We'll have the IFO later this morning. That's going to show Germany's doing really well. I think continental Europe, if you look at it just in pure infection rates terms, it's the vaccination progress is working. What we need now is for this recovery pact to actually get a lot of traction, and there's still a lot of disputes on it because of other factors like rule of law. My observation on the dollar is, I find it interesting, that we've got a situation now where a lot of commodities this morning or the last couple of days have been rallying despite a stronger dollar. So we're getting one of those disconnect moments because I think it's always important, because markets always go, oh, well, dollar up bad for commodities, dollar down good for commodities. Half the time that never works.
The other half is just a fluke.
Yes, yeah. There are moments when people haven't got anything to focus on, and that becomes the sort of central narrative.
Right.
And then we get into other things, and the issues around China are very important. I think the issues in the States now really boil down to, well, I think we've got two problems now. We're going to have good economic data, hard economic data. The question is, what does survey data do? And we've got downside risks on pretty much all survey data because everything's recovered quite strongly. So most of these are diffusion indices. And because they're diffusion indices, they basically ask the question, are things better, worse, or the same as last month? And once you get to a certain level of growth, they'll be the same as last month. It's not bad, but the diffusion indices, the survey indices, are going to actually start losing momentum. So people say, oh, lots of negative economic surprises. It's not actually the case. People, my problem at the moment is markets are so binary in their thinking that we swing from everything's fantastic to everything's negative, as we saw last week, so quickly. And I think that's really going to be the rule of thumb for the summer months. So we're going to get lots of spikes in volatility without actually achieving a lot, probably.
Omar, the decision last week, or was it 10 days ago now, with the OPEC Plus to obviously agree the output increase for the rest of the year, which we already sort of knew about, but the agreement for quotas beyond April, does that bolster your confidence, a bullish posture, knowing this sort of roadmap ahead beyond April for the rest of next year, that OPEC Plus are going to continue to maintain this agreement and perhaps the expectation of the discipline around it?
Well, no, I mean, I have zero confidence in OPEC. If I could have negative, confidence in OPEC, it would be negative. So OPEC have a history of shooting themselves in the foot every single time. I mean, it's very, very clear, right? So you have the two closest allies who basically, completely fall apart. And then you have the same kind of narrative. So the narrative was OPEC agrees, oil prices are higher, and then oil prices fall, and then the media doesn't know what to say, and then they're like, it's not OPEC, it's OPEC agreement overshadowed by the Delta variant. And then the market rises, and then they don't know what to say. They're like, we're rising, and let's see what happens. So again, I don't like these kinds of quote unquote narratives to do with what people are, sitting and deciding and might do and might not do in a year from now and maybe and if. I don't think that has very much effect on people's thinking as to where they allocate money. So people usually look for some kind of edge, insider information, and you go to jail, for example, or some other kind of information, whether it be a technical view or whether it be, flipping a coin. But you have to have some kind of edge. And I don't think fundamentals where everybody sees the same as you and everybody can count from 1 to 10 or 1 to 100 and say this is the positive, this is the negative, and all this kind of stuff. I don't think that gives you a kind of edge. So you have to find your kind of edge and look at markets in the time frame that you want, and try and make money if it goes up or down or sideways or whatever. But I don't think there's the broad overarching kind of thing is markets in general broadly are going higher. At some point, they're going to hit a brick wall, full force, straight in the face, and break their faces in a big way. When that happens, I don't know. But until that happens, the money basically is to that side. So you don't want to be short the S&P, you don't want to be short oil. Depends on which commodity, but in general, you want to be basically positive and buying stuff as opposed to negative and selling stuff. It's going to turn, but I don't know when it's going to turn, but it will, and in a big way.
Mike, on that point, I mean, ultimately, Omar describing the sort of nuances of what a trader might look for at an angle, but I would argue that this has been a momentum market for quite some time, and traders literally could have throw $1 on the bus and go to the beach and make $2. That period may be coming to an end. The momentum piece, I'm wondering your thoughts on that and the idea that this market has sailed on this sort of rebound thesis rather than recovery thesis, and perhaps we're coming to the end of that rebound, and now we have to ask, indeed, is there a recovery inside that rebound or not? Your thoughts?
Well, I think that's a good way to look at it. Look at the relative value in the market. Omar made it a good point. To me, one of the best trades for the last 10 years has been to at least last 6 years, we short S&P, short crude oil, long S&P. And that's also when you were rolling into contango was great. Now rolling in back creation is not as great, but that's been a great trade. My key point about what I'm looking at now is don't underestimate the enduring trends. And when they give you a relative edge, jump on them. Gold's giving you a dip. Bitcoin's giving you a dip. Crude oil's giving you a bounce in a bear market. Depends how you define it. It peaked in 2008 for half the price. When people talk about inflation, I'm like, where are you missing? This is the world's most significant commodity. It's half the price it was at its peak. So to me, that's the key thing to look out in the net. And the key one is the bond market, U.S. bond yields. I look at that long bond, 188 right now. The peak is 2.5. I think it's going to zero. What's the key thing to make the U.S. long bond go to zero? Maybe just a little stock market, bear market. It's got major precedent. They're zero in Europe. They're zero in Japan. I started trading JGBs, Japanese government bonds, in the late 90s. And everybody told me the same thing. They're short and they're happy, and they all been wrong. So to me, that's the key thing to think about second half. And I still think the better performers are going to be Bitcoin, gold, and U.S. long bonds. And if we just get a little bit of backup in U.S. stock market, crude oil has no chance of going higher.
Let's go to the survey question and give everybody else a chance to comment on this thesis. Robust U.S. economy will keep Brent above $70 a barrel through the third quarter, despite uncertain demand outlook in EU and Asia. Do you agree with that statement or disagree that the U.S. sort of 10,000 pound train will pull this whole world economy and the Brent price and keep it above 70 through the third quarter? And we'll see the hiccups in Asia and in Europe, but inevitably the US bionic train will do the trick. Your thoughts on that thesis, Mark?
I think in terms of oil, it probably actually dances around 70 rather than anything else, personally speaking. I think we just get a lot more volatility. I think Mike was making a good point about what's going on in the States with the bond market. The big problem here is there is no free float. There isn't a free float in US government bond market, and there's no free float in European government bond markets. And at the same time, we've got liability-driven investing. So basically what you've got is a story that pension funds basically are in a horrible position. Every time that someone talks about inflation and they basically don't buy, if suddenly people go, we're worried about the global economy, actually the inflation problems, they then have to chase it. And that keeps on forcing this liquidity problem, because basically you're going to have everyone chasing their own tails. That we've been seeing it for 10 years now since we introduced QE. So it's a lopsided market. It's not something which actually tells us anything about economic expectations, inflation expectations, but underlying liquidity conditions. But as long as yields remain low, then risk assets remain very, very attractive on any dip. That's the simple story on this.
Omar, looking to the week ahead, as we said, last week, we had our kind of trend down on Monday, up for the rest of the week. What do you see in terms of the structure of this week? We've had a pretty soft opening this morning, down over a percentage point. Your thoughts to the rest of the week?
So basically, let's start from the 65 low, right? So we're rallying from the 65 low, and I believe
on WTI.
On WTI. So if you look at the previous rally, anyway, to keep things simple, I think we're rallying from 65 to about 81, so about $16, something like that. So we've moved already from like whatever it is, 65 to 72. So we've got to correct that. That's $7. So maybe give back 3, something like that. And then basically, so let's say we get to 69 basis WTI, and then we pay a high. So in the very short term now, as opposed to next year and all this kind of stuff. So right now, I would expect this market to get to about 81 something. Once it gets to 81 something, we have just generally, we get like a big pullback, and that pullback can easily get to, low 60s, high 50s, something like that. And then from there, I think another big push up. But broadly speaking, so I like this market.
What about Omar in terms of the coming weeks? Obviously, hopefully even you will get some holidays and the market will, go into that wibbly wobbly space when all the brains are at the beach. Your thoughts, will that in any way disrupt the momentum of the direction that you're articulating?
No, so basically it's all about, markets are all about sentiment, right? Sentiment is great. And so everybody's happy now. So generally, it's the summer. It's good. It's people are traveling and all this kind of stuff. So it's not the time to be like ultra bearish and we're going to collapse. And I like what Mike said about Bitcoin. Bitcoin is the great kind of risk on asset, blah blah blah. So when does Bitcoin start to rise? When everybody forecasts its imminent death, and we go below 30 and we go to 1, and it's going to collapse, and what happens? And we trade higher, etc., etc. So it's the same. It's very difficult now to be kind of negative. It's always impossible to get to those turning points. The only time we're going to know that it's a big turning point is when the world gets a massive slap across its face. But people have been trying to say we're going to come off, it's going to happen now, it's going to happen now. But the reality is people need to make money, and to make money you have to be in the markets. And basically you can't call a top and you can't call a bottom. And I don't know where the top is, I don't know where the bottom is, but I do think right now it's time to basically be, the trend is your friend and the trend is higher, whether it be on equities, whether it be on Bitcoin, whether it be on oil. The trend is your friend and the trend is high. So if you want to make money, if you want to participate, you keep with the trend until it proves you wrong, and then you can think about something else to do. But I don't think it's a good idea when the trend is one way to kind of try and predict where it's going to stop, and it's not going to go higher than this, and we're going to sell here, blah blah blah, because most times you're wrong. So I prefer not to do that, but kind of ride the market. When you're wrong, when the market starts to dip, then flip everything. Sure, you're going to lose money, but you're going to have a new trend to trade.
Mike, the sort of trends, your friend, the big engine of U.S. economic growth and recovery. How is the summer going? What's your outlook for it? Is there anything in the U.S. outlook to be concerned about? They still haven't got anywhere on this infrastructure deal, but the summer remains strong. Summer driving season looks positive.
It's not good. Where the sugar high's wearing off. Put ourselves a year ahead from now. We've had the most significant fiscal monetary stimulus in history. The economy it's changed a lot. And so I fully expect a year from now, we're going to have some major issues with going back to where we were before. More abundant economy, slack demand for energy, and the Fed's going to have to keep printing money and more and so. So that's why Omar mentioned the trends. I view the best value in markets is gold, Bitcoin, and long bonds. They've had significant dips in their trends, and the key market that hasn't had just a little correction, which is overdue, is the stock market. And I'm not saying it's bearish, but we need to get over that. To me, the market needs a stress test, and that stress test is the stock market, just a little bit of a pullback and see how things do. Now, we got a little bit of that last week, and we all know what happens is crude oil drops double the velocity. I fully expect that. So the stress test will come, and I expect the better value is going to be I can't fade what that long bond's telling me. And it did the same thing exactly February 2020 when it started breaking the new lows. It told us, and as Mark mentioned, we got the government buying them. So you might as well go with that trend. To me, that's still a good bull market. I love it because it's completely contrarian.
Just quickly, Mike, on the American political landscape, is there going to be an agreement around this infrastructure deal, do you think?
Oh, yeah.
Yeah.
Go ahead, Mark. Yeah, take it.
Yeah. I mean, I think there will be a deal. It'll the debts and tied with a debt ceiling. I think the more important point actually for this week is we've got the energy, the big miners, and the big tech stocks all announcing earnings. We may be focusing on outlooks, but a lot of people will be looking at how many buybacks are there going to be, how many shared special dividends are there going to be, and that is going to be a big driver because everything at the moment is about the flow of money.
And that would be a very big amount of flow one would expect on those results. And that a sort of glass half full, that optimism, that sugar high will run, I think, through the summer. Let's get the quick answer to the survey before we let everybody go. Agree, yes, $70. The U.S. economy, Coney Island, is going to pull us all above 70 for the rest of the third quarter. Let's go eat some ice cream. Thank you, Mike, in New York. Thank you, Mark, in Poland. Omar, as always, anchoring Monday mornings in Dubai. Really appreciate it. If any of you guys are going on holidays, have a great one. We'll be here every morning, 10:30 UAE time. Thanks, guys. All the best.